When you purchase a building, you're typically not just purchasing a building. You might also be purchasing the land that goes with the building. And with accounting rules, we have to separate the cost of the land and the building. So, because land is not depreciated and buildings are, we have to separate or figure out what is the cost of the land versus the building with our lump sum purchase price. So if we just paid one price for both things, we have to somehow figure out a way to divide them between the land and the building. And one of the ways that we can do this is by using an outside independent third party to figure out what is the relative value of the land versus the building. And we can often do this with appraisals. So as an example, let's say that we paid $500,000 for a land and a building. We get an outside appraiser to come in and say the relative values of the land and the building. Perhaps they said it was $100,000 and $400,000. And so if the appraiser said that, hey, we can go ahead and use those values in the journal entry. So we get someone else to say, yep, this is, let's divide the 500,000 up between 100,000 and 400,000. So we would debit the land, 100,000, debit the building, 400,000, and then credit however we happen to pay for it. In this case, I'll just say we paid cash for this. However, it's not always this straightforward. If we hired this appraiser and they told us 100 and 400, sure, that's great. But often the appraiser comes back with values that don't add up to $500,000. They might say, well, the land was worth $200,000 and the building was worth $600,000. And we look at that and say, okay, well, that doesn't add up to $500,000. So we can't just put $200,000 in for the land and $600,000 in for the building, because now our journal entry won't balance. So that doesn't quite work. And we are often posed with this problem because we are using values that don't necessarily coincide or even have anything to do with our purchase. So, for example, we had to do this all the time, is that we had a client that bought land in a building, and for tax purposes and for financial statement purposes, we have to divide that up. They didn't go get an appraisal for this, and so we needed to find someone else that put together an appraisal that just shows what are the relative values of the land and the building. A very common place that we can get these appraisals are from counties, because for property taxes, counties have to determine what is the estimated market value of every single piece of property in that county. And that's how they divide up property taxes. And that whole system is maybe beyond the scope of this video, but just know that counties have to do this, and this is public information. It is often on the county's websites. So let's go look at St. Louis County in Minnesota, where we are located, and find out let's just pick a random building and see, all right, how much is the land worth and how much is the building worth according to the county. Again, this might not actually add up to what we spent, but we can use this information to guess at how much the land is worth and how much the building is worth. So let's go into, let's just get a random building here. There we go. And let's look at the property details. All right, so it gives us a lot of information. One of the pieces of information, though, are these assessment details down below. And so according to the county is guessing that the total market value, in other words, if this were sold, what would they get for it, is $3.8 million. Now, they break that down between what is the land worth and what is the building worth. And if you add those two together, you will see that it does equal $3.8 million. Well, let's say we paid $4 million for this piece of property. Let's go ahead and write that down. So we paid $4 million. According to the county, at least their best guess was that it was worth 3.85, so 3,853,200. And they broke that down into land, which was worth 717,500. And then the building was $3,135,700. So you can see that I have just copied the values here from the county's report into our scratch paper here. All right, so what is tempting for a lot of students to do is to just say, oh, the land is worth $717,500, the building is worth $3,135,700. Let's put those as debits, and then we'll credit cash $4 million. But again, the problem here is that the debits then wouldn't equal the credits. This price right here actually has nothing to do with what we paid for it. All we are doing is using these numbers as a tool to help us determine how we break up the $4 million between the land and the building. So what we can actually do is ask ourselves the question, according to the appraisal, what percent of the total price is the land and what percent of the total price is the building? So what we're going to do is we're going to take the land value and divide it by the total appraisal value and get a percentage. So if I just punch that into a calculator, I'm going to round it a little bit, 18.6%. Which would mean the building is the difference, right? So the building would then be 81.4%. So we can use these percentages to break up our actual purchase price into the land and the building. So if the land is 18.6% and the building is 81.4%, I will take the 18.6% and multiply it by $4 million. And so I would say I paid $744,000 for the land. And the rest of it would go to the building, or $3,256,000. Now I can put together my journal entry using the numbers that I calculated over here. So I would debit land, 744. Debit the building, the $3,256,000, and credit cash or accounts payable or notes payable, the total $4 million purchase price. All right, so in this way, I do want to point out the numbers over here that from the county, those do not appear in the journal entry. We are just using these as a tool to help us divide up our actual purchase price. And our actual purchase price most likely will not equal any appraisal that we get. We can just use the appraisal to figure out how we do the division between land and building. So this is called the lump sum purchase. And again, because of accounting rules, we have to divide up our purchase price between the land and the building. Land is not depreciated, buildings are. And so this division does affect our future financial statements because the building will have depreciation expense and the land will not.